Hey everybody, Frank Finance here. Hope you're having a wonderful day. In today's video, I'm going to be sharing my price target for Google Q2 earnings as well as highlights. We're going to look at my DCF model, and lastly, I'll give my final thoughts on Google as an investment. If you like this type of content, please consider subscribing, hit that like button. Now back to your content. All right, jumping into my price target for Google. As a reminder, Google completed their 20-for-1 stock split on July 15th, so this price target reflects it. So I have their price target $125 in the next 12, indicating about a 14% upside from where they're currently trading post-market around $110 a share. Now my DCF model gives them about $121 a share. I'll go over the assumptions later in the video, and my EBITDA multiple at 140. Same thing there. On the risk side, there's several points here. The first one is over 2021, they had extreme growth overall for the size of their company, and it attracted a lot of investors, which again, previously, in my opinion, were overlooked. And that sharp run up over the last 2 years, you have seen about a 20-25% drop off over the last year. Not nearly comparable to some of the other names losing, but still, they have really high margins. They've been doing really well. I think on the downside risk here, it's about $100 a share. And I think if they slip down to $100 a share, I'm definitely going to be thinking about entering and adding to my position. Now, the last point here is they gave little to no guidance for the remainder of 22, and I'll talk a little bit more of that in the earnings section. All right, so jumping into earnings reported today on July 26th, they reported $1.21 earnings per share compared to analyst expectations of $1.29. They missed by about 6% or 8 cents. On the revenue side, they reported $69.68 billion of revenue, and they missed by less than 1% or about $270 million compared to analyst expectations of $69.95 billion. Jumping into earnings highlights, growth for Q1, as a reminder, was 22.95%. Q2 dropped down to 13%. I think with constant currency, it was somewhere around 15 or 16%. Now, the cost increased year over year by 18%. So again, we're seeing increasing cost over what we're seeing in revenue. So negative there. And when I dug a little bit deeper into it, it looks like the employee expense is probably making that up. Employees increased about 20%. Headcount increased about 20% year over year. So it's probably what's accounting for that. Buybacks made up $15 billion in Q2 for a total of 28.5 year to date, or about 2%. Roughly 2% of the shares outstanding that they've been able to buy back year to date. Stock split has been a 20-for-1. That happened on July 15th. So that's if you had one share, now you have 20, and you can do the math, multiply basically by 20, and you'll get whatever you're supposed to have. On the cloud side, which is another high focus part of the business, it's obviously not even nearly the largest segment of their business, but it's something that folks like to look at. They increased their revenues by 35% year over year from 4.6 to 6.2, but they saw wider losses from negative 501 million down to 858 million. So about a 41% increase there in the amount of loss. Mostly, in my opinion, it's probably going to be towards employee expenses. That's probably what I would guess. On the guidance side, again, they gave no revenue forecast for Q3 of 2022. And as they were pressed during the press briefing, it didn't really sound like they really wanted to leave it to people for speculation. They really didn't want to give any sort of guidance for why comps or what's going to happen for Q2 in terms of ad revenue, whether it's YouTube or whatever it was. They really didn't give much guidance. So that was reoccurring throughout the press briefing. Now, on the last note here is they did say, and this was the only real guidance that they did give, was that they will be slowing hiring over the course of the remainder of 2022. They didn't say a hiring freeze. They just said they're going to be they said that they're going to be a lot more strict on who they hire moving through the rest of the year. And the last thing on guidance is they did say, and this I thought this was kind of funny, is they'll say, we'll know what it looks like when we get to 2023. Well, everyone will. So that's not guidance. That's just saying, hey, we'll tell you when we know. All right, jumping into my DCF model for Google. So the first thing I'll go ahead and draw your attention to is the DCF value and EBITDA multiple. In the price target section, I quoted off by a little bit, and that's because I didn't necessarily check my current shares outstanding. They had some share buybacks, and I hadn't factored that in. So that actually bumped it up by a couple bucks from around 121, 141 up to 123 and 143 respectively. for my DCF and EBITDA multiple valuations. So now let's go over some of the assumptions into the model. So for the remainder of the year, looking at 15%, and I'm estimating them going to 15% throughout the remainder of the year. The discount rate for Google is at 10% with a long-term growth rate of 5%. EBITDA multiple is 6 and a net debt of $60 billion. So that's basically $60 billion on their books. And last thing I'll say, I really want to go through is my EBITDA ratio, free cash flow ratio, and revenue growth. So looking at revenue growth, starting there, you see that they've been above 20 or really close to 20% for quite a while. They saw a slump in 2020, and back in 2015, they were below 20% as well. So I think estimating them at 15% moving forward is probably conservative. This year is probably going to be the down year. So moving forward, you could probably safely assume that I would say safely assume this, that always comes back to bite people in the butt. But historically, they've been able to grow at least to 15% in majority of years. So I think it's fair to assume 50% on average is going to be a good conservative estimate. Looking at free cash flow ratio, you can see that their free cash flow over the last few years, 4 years, has been increasing up to 26%. I think we're going to see those margins dip, so I've estimated them at 20% moving forward, and I think that's pretty good. We've seen them go up and down, so I think we're probably going back down on the cycle, and we're going to see it go back up. So I think putting it at 20% is conservative there. And on the EBITDA ratio, I have that going from 32% all the way down to 30%. If we look at the numbers over the last few years, I think you could argue this one a little bit higher, honestly, but they've only been below 30% 1 year. And I would say majority years before that, it just looks like they've been able to, I would say if anywhere, the trend has been going down. I think that's fair to say, is that the trend has been on the downside. So 30% is, in my opinion, respectable for the terminal period in 2026. It could be a little bit lower than that as margins get pressed a little bit more and competition ramps up. It could actually be lower than that, but I still think these numbers, the 30%, 20%, and 50% for EBITDA, free cash flow, and revenue, are conservative. Now for my final thoughts on Google as an investment. So the first thing I'll say is, globally, we're seeing folks across the board kind of not commit to Q3 and Q4 earnings. The rest of 2022, we're trying to wait and see what's going to happen economically. Are we going to see a downturn? Are we going to see a decrease in revenues across the board for these companies? Definitely hints towards that as people are ramping up or preparing themselves for a possible recession. A lot of companies are freezing hiring, et cetera, et cetera. So as we see companies do that, it may cause the stock to go a little bit lower. However, I do think from here, the max is probably 10 to 15% down. At least that's my gut as the market across the board. Google specifically, I think they are attractive at $100 a share. I've said that multiple times. And for me personally, I'll consider adding to my position. Since they've been able to drop 25 or 30% this year, something like that, I really do think that Google presents a really strong value. The DCF calculation, in my opinion, is conservative. I believe Google has several more years left of revenue growth in them, and they're continuing to innovate and have lots of excitement, in my opinion. I really love their products. I really like what they're doing, and I like their leadership. In my opinion, Google's a solid investment, especially in times of uncertainty. If you like this type of content, please consider subscribing. Hit that like button. Thank you so much for watching. My name is Frank Finance, out.